You check your banking app right now. A number appears. You trust it completely. You never once ask if that money's actually sitting in a vault somewhere waiting for you. But here is the strange truth. It isn't. Almost none of it is. And if everyone tried to pull their cash out on the same day, the entire system would collapse within hours. And this sounds like a conspiracy theory. It isn't. It's just how banking has worked for centuries, hidden in plain sight, taught to almost no one. Start with what a bank actually does. You deposit money. The bank does not lock it in a room with your name on it. It lends most of it out almost immediately to someone else, a mortgage, a car loan, a small business line of credit. Your deposit becomes someone else's borrowed dollars within days. This system has a name. Economists call it fractional reserve banking. Banks are only required to hold back a small fraction of deposits in reserve. The rest goes to work, earning interest, funding the economy. Yeah, it sounds efficient. It is efficient right up until everyone wants their money back at once. The economists Douglas Diamond and Diamond-Dybvig built a famous model in 1983 that explains exactly why the system is so fragile. Their insight was simple but unsettling. A bank can be perfectly healthy, its loans performing, its balance sheet sound, and still collapse in a single afternoon. All it takes is enough people believing it might fail. The belief itself becomes the disaster. Think about that for a second. The bank doesn't need to actually be in trouble. It just needs enough people to fear that it might be. This is called a bank run, and it behaves like a wildfire in the mind of a crowd. One person hears a rumor. They withdraw their savings just to be safe. Their neighbor sees the line outside the branch and panics too. Within hours, thousands of rational, careful people are standing outside, demanding cash the bank simply does not have on hand. Not because the bank was reckless, because no bank on earth keeps that much cash sitting idle. You've probably seen this scene before, even if you've never lived through it. Grainy footage of crowds outside banks during the Great Depression, people clutching passbooks, faces tight with fear. In the United States between 1930 and 1933, thousands of banks failed as this exact panic spread from town to town, feeding on itself. It wasn't one crisis. It was millions of individually reasonable decisions made at the same time that added up to catastrophe. So what actually happens mechanically if everyone withdraws their money at once? The first bank to feel it runs out of physical cash almost immediately. Banks typically hold only a small percentage of total deposits in reserve, sometimes in the low single digits. The rest is out as loans, mortgages, and investments that cannot be called back on short notice. A 30-year mortgage does not unhappen because depositors are nervous. Once the cash runs dry, the bank has three options, and none of them are good. It can try to sell assets fast, often at a steep loss, a process economists call a fire sale. It can borrow emergency funds from other banks or the central bank, or it can simply close its doors, freezing every account inside it, whether that customer was part of the panic or not. Now scale this up. If it's not one bank, but every bank, simultaneously, there's nowhere to borrow from. Every institution is drowning in the same demand at the same moment. Cash machines run empty. Card payments start failing because the banks processing them have no liquidity to settle the transactions. Grocery stores, gas stations, and pharmacies, all of them tied to the same electronic payment rails, would grind toward a standstill within days. This isn't speculation. It's close to what nearly happened in 2008. When Northern Rock, a British bank, faced a run in September 2007, footage of customers lined up around city blocks was broadcast worldwide. It was the first bank run in the UK in over a century. The panic wasn't really about Northern Rock's balance sheet. It was about what everyone else might do next. Here's the twist almost nobody talks about. Governments already know this can happen, and they built a psychological firewall specifically to stop it. After the wave of collapses in the 1930s, the United States created the Federal Deposit Insurance Corporation in 1933. Its entire purpose wasn't really to protect your money directly. Its purpose was to protect your belief that your money was safe. When deposits up to a certain limit are insured by the government, the incentive to panic and run to the bank disappears. If you know you'll get your money back either way, there's no rational reason to sprint to the front of the line. The economist Charles Kindleberger spent decades studying financial panics across 5 centuries, from Amsterdam in the 1600s to Wall Street in the 20th century. His conclusion was almost poetic in its bluntness. Panics are not caused primarily by bad economics. They are caused by crowds of people reacting to other people's reactions faster and faster until the reaction becomes the event itself. Your brain, it turns out, is not built for banking. It's built for the savanna. For tens of thousands of years, when everyone around you started running with them kept you alive. There was rarely time to check if the threat was real. The cost of hesitating was too high, and the cost of following the herd was almost always survivable. That ancient wiring hasn't gone anywhere. It just moved from predators to passbooks. Why does a false rumor spread faster than an official denial? Because your ancestors' brains treated social proof as data. If 3 people are running from the tall grass probably contains something dangerous, whether or not you personally saw it. Modern banking panics run on the exact same software, just wearing a suit instead of animal skin. There's a deeper irony sitting underneath all of this. The very trust that makes banking work at all is the same trust that, once broken, breaks everything at once. A bank is really just a machine for turning short-term promises into long-term investment. It only functions because almost nobody tests the promise on the same day. Pull that thread, even slightly, and the entire structure that funds mortgages, businesses, and paychecks around the world starts to unravel. So the honest answer to the question is this: if everyone withdrew their money at once, banks would fail within hours, not because they were poorly managed, but because no financial system on earth is built to survive universal, simultaneous doubt. The machine depends on almost everyone trusting it, almost all of the time. Tonight, you'll check your balance again without thinking twice. That number on the screen isn't really cash. It's a promise, backed by insurance, backed by regulation, backed by millions of strangers quietly agreeing not to test it today. You're not just banking, you're participating in one of the largest shared beliefs in human history, and the moment enough people stop believing it, the belief is the only thing that was ever really holding it up.